Today, SpaceX is not just a company story. It is a market structure story. That distinction matters because a great company can still be a difficult stock to buy at the wrong moment. SpaceX can launch rockets, dominate satellite internet, win defense contracts, and still leave public investors exposed if the deal structure sends too much supply into the market too quickly. So this video is not about calling SpaceX a bad business. That would be lazy. It is also not a recommendation to buy, sell, or short the stock. The goal is simpler and more useful: to show you the calendar behind the excitement. Because when a company this famous goes public, most people stare at the first day price. They watch the opening trade. They watch the green candle. They watch financial television celebrate the valuation. But the smarter question is not, how high did it open? The smarter question is, who is allowed to sell next, and when? That is where the SpaceX IPO gets interesting. The stock was priced at $135. Reuters reported that the IPO raised $75 billion and valued the company at about $1.77 trillion before trading pushed the value even higher. Business Insider reported that SPCX trades on NASDAQ and that the shares jumped as much as 30% during the first session, before closing with a strong gain. That is the loud part of the story. The quiet part is the lockup schedule. A lockup is a restriction that prevents insiders, early employees, founders, and venture investors from immediately selling their shares after an IPO. The reason is obvious. If everyone who bought in years ago could sell on day one, the market could be flooded with supply before public buyers even understand what they are buying. Traditionally, many IPOs use a simple lockup. Roughly 180 days pass. Then the restriction expires. Everyone knows the date. Everyone waits for the same cliff. SpaceX did not use that simple version. Instead, the structure is layered. Some shares unlock after earnings. Some unlock after fixed day counts. One extra release can happen if the stock trades high enough before the first earnings report. Elon Musk and certain major holders are locked for longer. That means there is not one date to watch. There is a sequence. Start with the performance trigger. Morningstar reported that eligible investors can sell up to 20% of their stock starting on the second full trading day after SpaceX releases its first earnings report as a public company. It also reported a performance-based trigger. An additional 10% can become eligible if the stock trades 30% above the IPO price for at least 5 of the 10 trading days before that earnings release. The math is simple, but important. 30% above $135 is $175.50. That number matters because it turns excitement into a mechanism. If SPCX spends enough time at or above $175.50 during the relevant window, the deal can release more insider supply earlier. In plain English, a strong rally can help open another exit door for people who owned the stock before the public did. That does not automatically mean the stock crashes. It does not mean insiders must sell every share. It means the supply picture changes. And in markets, supply matters. Now put the dates on a calendar. SpaceX began trading on June 12, 2026. Treat that as day 0. Day 70 lands on August 21, 2026. That is the first fixed time-based unlock, with 7% of eligible insider shares becoming available for sale. Day 90 lands on September 10, 2026. Another 7% becomes eligible. Day 105 lands on September 25, 2026. Another 7%. Day 120 falls on October 10, 2026, which is a Saturday, so the practical market date would move to the next trading session. Another 7%. Day 135 falls on October 25, 2026, which is a Sunday, so again the practical market date is the next trading session. Another 7%. Those 5 time-based tranches add up to 35% of eligible insider shares. Then there are the earnings-related releases. After the first public earnings report, up to 20% can unlock. After the next quarterly earnings report, another 28% can unlock. At day 180, which lands on December 9, 2026, the remaining standard restrictions lift for the eligible group. Musk's own restriction is different. His 366-day lockup points to June 13, 2027. So the investor's real timeline is not one trading day. It is not even 1 week. It is a 6-month supply path, followed by a separate 1-year founder lockup. Why would a company choose this structure? There are 3 practical reasons. First, it avoids one giant cliff. A single 180-day expiration can become a very visible event. Everyone sees it coming. Traders position around it. Headlines write themselves. A staggered structure spreads the pressure across several dates, which can make the process look calmer. Second, it helps grow the float over time. Float means the number of shares actually available for public trading. When the float is small, small waves of demand can push price around more aggressively. More float can make trading more liquid, but it also means more potential supply. Third, it gives early holders predictable liquidity windows. That is not evil. Employees and venture investors waited years. Many of them took risk before the public market ever had access. They are allowed to want liquidity. But public buyers should understand that their demand may be the liquidity those early holders are waiting for. That is the uncomfortable part. The public buyer often sees a dream. The early holder sees an exit window. Both can be true at the same time. This is why the phrase, "great company," is not enough. Investing at a good price requires understanding the business, the valuation, and the supply schedule. Ignore any one of those, and you are not analyzing the stock. You are reacting to the marketing. Now let us talk about valuation, without pretending anyone can price SpaceX perfectly. SpaceX is unusual. It combines launch services, Starlink, defense exposure, artificial intelligence infrastructure ambitions, and long-term projects that sound more like science fiction than a normal income statement. A standard valuation model will struggle with that. But struggle does not mean ignore the numbers. At a listing valuation around $1.7 trillion and 2025 revenue reported around $18.7 billion, investors are paying a very large multiple of sales. They are not simply paying for last year's business. They are paying for what SpaceX might become if several enormous markets develop in its favor. That is possible. It is also risky. The mistake is not believing in the future. The mistake is paying for the future as if it has already arrived, then acting surprised when the stock becomes volatile. This is where IPO history helps. Rivian was exciting. Its product was real. Its story was huge. But when its lockup expired, the market had to digest a new supply reality. Uber was a category-defining business. That did not stop the stock from struggling around its lockup period. Palantir had passionate believers and a powerful narrative. Insider selling still mattered. Snowflake had a premium growth story and a staggered structure. The stock was still sensitive to unlock events. None of those examples prove SpaceX will follow the same path. They prove something more basic. Lockups are not paperwork. They are part of the trade. Now add Elon Musk. Musk's 366-day lockup will be presented as a vote of confidence, and that is partly fair. The founder cannot sell during the normal 6-month window. That matters. It tells the market the most visible person in the company is not heading straight for the exit. But do not confuse that with no insider supply. A founder lockup can be strong signal and still leave other early holders with liquidity windows. Early employees, funds, executives, and pre-IPO investors may have very different needs. Some have fund cycles, some have personal diversification needs, some have clients who expect distributions, some have life-changing wealth tied to one stock. So the correct read is balanced. Musk staying locked is positive. The rest of the unlock calendar still matters. What should a normal investor actually do with this information? The weakest answer is to chase the first day pop, because everyone is talking about it. That puts you in the most emotional part of the market. Before the first earnings report, before the supply path is tested, and before the valuation has been challenged by public numbers. The other weak answer is to reject the stock forever, because the deal is aggressive. That may feel disciplined, but it can become its own kind of laziness. Some extraordinary companies go public at uncomfortable prices and still become worth more over time. The stronger answer is patience with a checklist. Watch the first earnings report. Do not just look at revenue. Look at losses, cash burn, capital spending, segment performance, and management commentary. Watch whether the stock trades around the performance trigger level. The important number is $175.50, based on a $135 IPO price. Watch the August through October unlock window. That is where the repeated 7% tranches start to matter. Watch the second earnings report. That can release another large block of eligible shares. Watch December 9th, 2026. That is the day 180 mark. And if you care about Musk's personal selling window, watch June 13th, 2027. None of this requires predicting the future. It requires refusing to be rushed. Let me make this practical with a simple mental model. Imagine a concert venue with only a few hundred tickets available at the door. Everyone outside sees the crowd and assumes the event must be amazing. The first tickets trade at higher and higher prices because there are not many of them. But behind the building, thousands of reserved tickets are scheduled to be released in waves. The show may still be excellent. The band may still be legendary. But the price of the ticket depends partly on how many tickets enter the market next. That is what a small float can do in an IPO. It can make the first price feel more meaningful than it really is. When only a small slice of the company trades, the day one price is not a clean vote from the whole market. It is a vote from the portion of the market that could actually get shares, competing for a limited float during the most emotional moment of the listing. That price can be useful, but it is not final truth. This is also why passive index buying can complicate the picture. If a stock becomes eligible for major indexes, funds that track those indexes may need to buy regardless of whether their managers personally love the valuation. That demand can support the price in the short term. But forced buying is not the same as fundamental conviction. It can create a wave. It does not guarantee where the stock settles after the wave passes. So the cleanest way to think about the next 6 months is this. Demand will be tested against new information and new supply. The new information comes from earnings. Public companies cannot live only on vision. They have to report numbers. Revenue growth matters. Margins matter. Losses matter. Capital spending matters. Cash flow matters. Segment quality matters. A company can have a massive opportunity and still disappoint if the path to profits takes longer than the market expected. The new supply comes from unlocks. Every time a restriction lifts, some holders gain the right to sell. They may not sell immediately. They may sell a little. They may sell through planned programs. They may hold everything. You will not know in advance, but the risk becomes real once the right to sell exists. That is the difference between a locked share and an unlocked share. A locked share is future supply. An unlocked share is potential current supply. For retail investors, this is where discipline has to replace excitement. You do not need to prove you were early on day one. Public markets are open every trading day. If SpaceX becomes a durable compounder, there will be many chances to build a position with more information. If the market reprices the stock lower after unlocks or earnings, patience protects you. If the stock keeps rising without giving you a comfortable entry, you missed a trade, not your entire financial future. That sounds boring, but boring is often profitable. A sensible watch list for this IPO would have 4 columns. Column 1. Date. Put every unlock and earnings window in the calendar. Column 2. Event. Is it an earnings release, a fixed unlock, a performance trigger, or a standard lockup expiration. Column 3. What to check. For earnings, check revenue quality, losses, capital expenditures, and cash flow. For unlocks, check volume, insider sale filings, and price reaction. Column 4. Decision. Do nothing, study more, start a small position, add only after confirmation, or avoid because the valuation still does not make sense. Notice what is missing from that checklist. Panic. There is no need to panic buy because the stock is green. There is no need to panic sell because an unlock is coming. The job is not to react to one headline. The job is to build a process that survives the headline. That is the broader lesson of this IPO. The public market loves a simple story. SpaceX is not simple. The business is complex. The valuation is complex. The lockup is complex. The index mechanics are complex. The founder control structure is complex. If the story is complex, the decision process should be more careful, not more emotional. So by the end of this video, the point is not SpaceX is bad. The point is, do not confuse access with advantage. Getting access to a famous IPO does not automatically mean you have an edge. Sometimes the edge belongs to the people who owned the shares years earlier. Sometimes it belongs to the people who understand the filing. Sometimes it belongs to the investor who waits until the easy enthusiasm has been replaced by harder numbers. That investor may look slow on day one. 6 months later, that same investor may look much smarter. The most useful habit here is not memorizing the SpaceX calendar. It is learning how to read any IPO before the headline gets into your head. Ask 3 questions. What % of the company is actually trading? When can insiders sell? What price or event can change the supply schedule? Those 3 questions will protect you from a lot of expensive excitement. SpaceX may become one of the most important public companies in